The data shows that passive funds outperform their active counterparts, and over a 20-year period, 95% of passive funds will outperform active managers. So it's probability, and the probability says you're better off in a passive than in an active. I'm looking at asset allocation, which means what's in equities, what's in properties, what's in fixed interest commodities. That drives 80 to 85% of returns. I'm looking if it's actively managed or passively managed, and I'm looking for complexity. The answer is the stats say no. It's a probability game. You know, we like numbers as a tax advisor and as financial advisor or financial planner. We look at probability. And over a 20-year time period, index fund will outperform 90 to 95% of active managers. So will there be an active manager that will outperform the market? Yes. Are the chances that you will buy, hold and stick with him likely? Well, no, the odds aren't in your favour. And even if you do get the right manager, as an investor, sometimes you don't get the returns. And I'll give you an example. There was a chap called Peter Lynch in the 80s and 90s that invested for Fidelity, and incredibly successful investor, averaged an annual return of 29% over 11 years, I think. And the average investor's return was about 3% because the volatility was so sharp that at the bottom of the market, people sold, and at the top, they bought. And it's that fear and greed emotion. So my view is I stay away from it. And another good example is Terry Smith from Fundsmith Equity, which a lot of clients are invested in. Hargreaves Lansdown were pushing this. He was a star investor. He did incredibly well at the beginning of the fund when he had less assets to manage. And what happened is money was flooding into the fund. And when you've got a lot of assets to manage, it's much harder to get a return. So it's dramatically underperformed its benchmark over the last 5 years. So in terms of active and or passive, or what we would call scientific investing, we would lean away from active. But that's very much an important part of the portfolio, and a lot of that's about education. And the other thing I look at, if we go back to the first question, is the asset allocation. So are there bonds in the portfolio? Is it equities? Is there commodities like gold or anything like that? Because I've seen some cases where you've got a 30-year-old dentist that's got 40% of bonds in their portfolio, and it's more of a defensive asset. Whereas if you're accumulating wealth and you're early on in your journey, you want to be pushing for growth assets, which would be equity. And asset allocation, the amount of assets you have in different pots, essentially, drives 80 to 85% of returns. So that is incredibly important.
Okay.
Great question. And it's an easier question to answer for clients when they are invested in a more passive portfolio, because when the market goes down, your funds go down. When the market goes up, your funds go up. When they go down disproportionately, it's a difficult question to have. And we used to have active fund managers for our clients. And when they'd underperformed the market dramatically, when there was a big downturn, our clients were saying, hey, look, what's going on? And essentially our message was, look, it's a long-term investment, but the fund managers just haven't done what we expect of them, which wasn't a nice conversation.
Like they need to be shown to do something rather than just sit back, recover. That's the game.
That's it. And so to answer your question, at the beginning of clients' journeys, when that first bear market comes, the first decline comes, it can be quite nervy. Usually after the first one, that they're absolutely fine. They understand the volatility, but staying in your seat is one of the most important parts of our job, helping clients to stay in their seat. The most expensive mistake was a crypto scam. So they probably ended up investing about £800,000 with a company that looked like a crypto platform. And the way they started with £250. So they know what they're doing, these scammers. And they gently asked for more money, And then they kind of said, look,
just enough of a return to feel genuine.
Well, they showed them the return. They said, look, this is what it's done in mark with in mark with an index or whatever coins that they were invested in.
Yeah.
And then they kept on asking for £85,000 for like an anti-money laundering amount to kind of verify that they were, they had source of funds, which doesn't really make sense. But that figure is important because, it's tied to anti-money laundering. So they invested another 85,000, and then they basically kept on going. And the way that we found out about it was they were talking about drawing some money from their pension when they came to us and said, we need to draw some money for your pension. We say, well, what's it for? And they said, well, it's for this. We need to put some more money in. And we kind of said, well, hold on a minute. Let's have a little look. And unfortunately, it was a case that money is gone.
And I guess that's another part of your role. You're not policing what you want to spend your money on, but you're just like, well, we might have some better options to look at, perhaps. Maybe leaving it in the pension is actually going to be the best result.
Well, that's it. And I only wish we would have got in front of that person sooner, and they would have spoken to someone and said, look, what do you think of this? And then we could have said, look, this is a red flag. Because as soon as I heard it, I just thought, oh no, my heart sank, and I thought I'm going to have to deliver some terrible news to these people. I do what I recommend, so low friction, low effort returns outside of my business, high effort within my business. So I either invest in our business, our wealth management business, or I invest in the public markets. Behavioural management, I would say, making sure you stay in your seat, making sure that you're spending enough money. A lot of our clients don't spend enough or spend too much. Make sure that they're getting ongoing reviews of their inheritance tax position, and also make sure they're talking to the right people. It might not be that I add the most value one year, but an introduction to someone like yourself, who recently has helped a mutual client of ours save £20,000 a year in tax, means that they're going to get the right advice, even if it's not tailored specifically to financial planning. Definitely not. Definitely not. I mean, 34, you're probably still going to be working at least for another 15 years. And you can compound a lot of money from tax savings and also investment growth. So absolutely not. I mean, even if you've not saved into a pension 5 years before you're exiting your practice, it's still not too late, as long as there's enough equity in the business. I'll give a sweeping statement here. The advice needs to be specific to that client, but usually if you're opting out of the NHS pension, you're giving up free money. And what I mean by that is you will contribute to your NHS pension, but the NHS will make a large contribution. It might be around 30, depends on your earning brackets, but it's around 30% of your earnings into that pension, which is a huge amount. So I'd think very carefully before opting out. And in fact, I'd say you want to have it reviewed before you make that decision. Well, in most cases, probably not, because the structure of how they pay themselves has likely changed. And so you need to get it reviewed, because stuff like income protection is based on your personal income, not what profit goes into the business for most policies.
Okay.
But the main question is you need to get it reviewed. And you should be getting it reviewed on an ongoing basis anyway, because one of our clients recently who came on board has been paying an income protection policy, paying for an income protection policy. However, within his company, he's got 2 dental practices and he's got some property which provides him income. So if he was unable to work, the companies would generate enough income to continue to pay him 100,000, which is what his income is. However, because his income would continue to be paid, the insurer, it was LV in this case, would take that payment into account. So effectively, not pay out at all. So he's been paying £175 a month for the last 11 years when this policy wouldn't have paid out. And it may have been that was suitable when it
11
first,
years ago.
Exactly.
Yeah.
But now it's a case of saying, well, actually, we've just saved you a bit of money there, because it wouldn't have actually paid out. Fees, so direct fees paid from a client, that might be an initial fixed fee for setting up the contracts and onboarding, 1% of the assets that we manage, and we also get paid via commission. So you pay premiums to an insurance provider, then they pay us a commission for setting it up. The impact that we've had on families that seem to have had very basic advice, and that's not against the advice industry, it's that there are financial advisors, then there are financial planners. So the financial advisors have done their job, they've sold them products and they've set up a pension. But when you can go to somebody and really say, well, actually, they want to spend more time with their kids going on big holidays, can they do that? Can they afford to do it? And I can give them the news, well, yes, not only can you, but you should be doing these things because it's important. It just means you're going to have to work a few extra years. Giving that news and that clarity to someone it makes me think that I'm in a really privileged position to be in the profession that I'm in, because it's it's not a rehearsal. You only get one chance at doing this thing, and helping someone get to that conclusion and make those plans themselves is really rewarding.
Really simple answer to that is it's never too soon.
Yeah.
I don't believe. There's things we might want to do in tax. There's things you might want to do in the practice to get the best, make it be the best thing it can be at the moment it comes up for sale. You want to aim to sell it when you don't really want to sell it anymore.
Yeah.
Some of the tax planning we might want to do sometimes needs 5 years. I quite often have conversations with people who were buying a practice, and I'm saying, well, hang on a minute, let's just think about what does the next 10, 20 years look like? What might an exit in 20 years look like? And that's even when we're at the start of buying it.
Yeah.
So it's never too soon, but it's also never too late. So
yeah, I'd agree. And I think in a case that we've actually looked at together, we were talking about this very thing in terms of buying a practice for a husband and wife team, and actually using a trust to buy a bit of it through their parents. And obviously we can talk about the details of that another time, but that one bit of tax advice before a business purchase could have saved them around 500, 600,000 in tax.
Yeah.
So I'd agree. It's never too early.
It's a normal type of company, but with a special purpose. So an FIC is generally designed as an inheritance tax planning tool, not really an income tax planning tool, but an inheritance tax planning tool to begin to pass wealth or set the framework for growth in the existing wealth, so future wealth to begin to pass down to the kids. It's a company that's generally set up to be run by the parents but owned by the kids.
And why is it so attractive? Why does it seem to be such an attractive proposition?
I think over the years, they're doing a job that trusts used to do. Trusts have been around for centuries, but over the years, those tax rules have been eroded. People's general kind of wealth base has gone up. They're starting to think about things now. We've got changes in inheritance tax rules that mean things that previously weren't caught by it now are. There's just more people thinking about IHT, inheritance tax, and FICs, family investment companies, become a natural tool that people turn to. And it's a bit of lingo at the moment, isn't it? It's kind of, there's people out there trying to sell it. So it's become something that we hear more about. Our clients have heard about it somewhere. There's always the mate down the pub.
Yeah.
And they want to know more about it. And great, in the right circumstances, it's a fantastic tool for what it does.
And it's familiar, isn't it? The structure in terms of, profit.
It's a limited company. A lot of people running their dental practices, or even as an associate, will be familiar with how does a limited company work? Shareholders, dividends, salaries, things like that. All those things are more familiar than the world of trusts.
Yeah.
That people probably haven't hugely encountered.
Yeah, I'd agree.
So an SPV, special purpose vehicle, basically what the lender is after, and we're talking about buy-to-let residential lending to companies, they're after a limited company that doesn't do anything else. So the company will be set up with certain industry codes, certain articles that say this company's for buy-to-let property. This is what it's for. It's not got any trade mixed in with it, nothing that can jeopardize and add risk to the lending.
Okay.
It's also usually not part of a group. So it's owned by natural people, by individuals, to buy-to-let property only. Yes, but if you're coming back, that's when our tax rules are going to kind of catch you out anyway, particularly if you're back within 6 or 7 years.
Yeah.
And even if you're overseas, UK assets are going to be subjected to UK income taxes, inheritance taxes anyway. So I would say maybe don't move abroad to save tax, but let's get you the best tax situation if you are planning to move abroad.
Yeah, that makes sense. And so if you do set up an FIC over here, it's a UK company, let's say you've got £1 million in it, just for math's sake, you move to Dubai, something happens to you, that £1 million, it's taxed at 40% inheritance tax. Is that correct?
Yeah.
And actually, funnily enough, I know that all the people that I've known that have moved for tax reasons have actually moved back and just said, I'll take the tax consequences, but I just don't want to move away.
There's other countries, but this is where you get people that they'll give the impression of, well, I'll go anywhere to pay less tax, but we start to kind of, where is the anywhere? They want to be in Spain, and you pay the tax there anyway.
Yeah.
It's a yes and no answer. So school fees are never going to be a business expense. They're nothing to do with how your company runs. But limited companies gives you a huge amount of flexibility to pay all of your personal expenses in the most tax efficient way. So having a limited company gives you options, and knowing that school fees exist in your world, that they are probably your biggest monthly outgoing, becomes a huge part of the planning that we would always do with people. There are some things you can do with, maybe not having income from a company, but loans from a company, coupling that with pension contributions to offset some taxes and create some advantages in the future. That can work really well in the right circumstances.
Yeah.
So yes, companies can help your school fees become more tax efficient, even though they don't pay for them directly.
Yeah. And we've actually got multiple clients that use that strategy, keeping their income below 100,000, and making sure that's all set up properly, which has got a clear plan to repay that loan.
Yes.